You can now buy a property in Australia with just a 2% deposit if you meet the certain criteria, which we're going to get into in this video. So firstly, we saw the first home loan deposit scheme, which allows you to buy a property with just a 5% deposit. And now we're going even lower. So this is of course going to give people more and more access. So for some people, it's going to be quite beneficial. But in this video, I'm also going to highlight some risks as well that come into play if you do decide to use this scheme, more from the home loan point of view, because I have worked as a broker before, and I think if you are looking to take a home loan for that amount, you do need to know some risks that come into play. I literally mentioned the whole broker thing in every single YouTube video that I do about home loans, but I do think it's important for you guys to know where I'm coming from. Hey guys, my name is Faizi and this channel is about finance and investing, and we also discuss home loans on this channel sometimes as well. Before we begin, this video is not financial advice. I'm not a financial advisor. Please do some research as well on this if you are looking to use this scheme. Let's get into what this is and what the criteria is specifically. So this scheme is called the Family Home Guarantee, and it allows you to buy a property with just a 2% deposit without paying LMI, which is pretty huge because LMI is a cost that every first home buyer has to tackle somehow. And how this LMI is avoided is that the government basically covers the rest of the 18% and they provide a guarantee when it comes to the loan. So basically you're still going to have a loan for the 98% of the property value. So first, the main criteria of this scheme is that you have to be a single parent and you do have to have at least one dependent. Now this scheme is specifically made for these guys because often when people are looking to buy a property, this demographic of being a single parent is often the most disadvantaged because they've got a dependent, and for them it's quite hard to save a property because often they only have one source of income. And because of that, their borrowing power is significantly reduced, and as we've seen recently in the past couple of years, with the significant increase in house prices, it means that the access that those guys have to the markets is very little. So if we look at it from that point of view specifically, it is a good change. Now with this scheme though, there's only 10,000 spots over 4 years, so roughly 2,500 spots per year. And this hasn't actually come into effect yet. We still have about 3 to 4 weeks until it comes through, and it's going to start on the 1st of July this year. Now of course, as with all these schemes, it is for owner occupiers only, not for investors of course, and you can probably guess why that is the case, and you do have to live in the property as well. And additionally, you can't actually own any other interest in other property in Australia when you're actually going for this scheme. So what that means is that you could have bought a property before, but as long as you have no ownership at this present time, you should be okay. So that's pretty good because this scheme applies to people who are not just first home buyers, but people who have bought a property in the past as well. And you can also buy existing property, which is huge. You don't have to buy a brand new property. This scheme also applies for house and land packages and off the plan purchases as well. Now I think this scheme is going to be pretty common among single parents who are probably married before and they owned a joint property before, and for whatever reason they have now divorced, and let's just say that the ex-husband has kept the property and he's basically paid out the wife's share. So consequently, it could be that now the ex-wife is a single parent once again, looking after the kids, and wants to now buy her own property. So this scheme is definitely going to help in this scenario, and of course this is just one of the many scenarios that you could be in as well. So as we saw with the previous first home loan deposit scheme, this is only for Australian citizens only, not for permanent residents unfortunately, and you have to have earned less than $125,000 in the previous financial year. If you are earning more than that, then this scheme unfortunately will not apply to you. The loan does have to be principal and interest over 30 years as a maximum. Some lenders do offer loans up to 40 years as well, so that is definitely not allowed under this scheme. But of course, not a lot of people get a 40-year loan anyway, so that's going to be fine for most people. Now guys, with schemes like this, usually they have caps and certain criteria to make sure that the right people have access to this scheme. And of course, they don't want people who are high income earners to take advantage of schemes like this, which is why there is an income cap. But there's also a property cap as well, so let's have a look at it. So having a look at the property price cap for this scheme, for New South Wales, the maximum price that you can actually buy a property for will be $700,000 for this scheme in capital and regional city centres. Now, if you're living outside Sydney, for New South Wales, 700k should usually be fine, and the rest of the state is 450k. That should be fairly fine as well. But if you are looking to buy in Sydney, it's going to be quite tough to find anything less than 700k, but it is possible. You do have to look in the greater Western Sydney region or even the southern region near Campbelltown or some other areas. It does suck though. You are going to be living quite far from the city, but that's just a drawback of having a low deposit, unfortunately. Now keep in mind guys, they do want to incentivize the right people, so they can't have the property price cap to be too high anyways. Because if you really think about it, if they made the price cap $1 million for, let's say specifically Sydney, that means that for that purchase price, the deposit needs to be $20,000 and the loan amount has to be $980K under the scheme, which means that for a maximum income of $125K with dependents and with this massive loan, there is no way that you're going to be able to service this loan anyway, so there's no real point in having such a high property cap. So you will need to maximize your borrowing power, and if you are looking to do that, I've done a whole video on this already. There should be a link in description and there should be a link somewhere on the screen as well. That video has 3 proven ways you can increase your borrowing power. It's packed with value, so go check it out afterwards. I think it'll help you quite a bit. I think in some states where the first home owner's grant is like $15,000 and building a house in those states is not as expensive as Sydney, you might even be able to get a loan without a deposit because you can combine this 2% scheme with the first home owner's grant as well, and that'll basically cover you. For example, if you're buying a land and building on it, and doing that costs you $300,000 each, so $600K in total, the deposit that you'll need, which is 2%, is going to be $12,000, and the first home owner's grant is going to basically effectively cover your initial costs. But just keep in mind that if you are looking to do something like this, the banks will still need to see genuine savings, and genuine savings is basically having money saved in your account, which is 3 months worth of your own savings. Now guys, if you are finding value so far, please leave a like or subscribe. It really does help out with the YouTube algorithm. Let's continue. So basically that's the scheme. Now let's talk about some risks that I see with this whole arrangement that the government has proposed. I'd like to show you guys a balanced perspective when it comes to all of this. Now, the issue that I see mostly is the fact that looking at it from a purely home loan point of view is that you virtually have like no equity, meaning that if the property prices were to move against you at any point in the future, you're basically stuck with the bank. So what could potentially happen is that the house may be worth less than what the loan is. So the loan could be $500,000 and the house could be worth $450 as an example. Now guys, just keep in mind that if this was to happen, the bank isn't just going to call you up or knock on your door and just ask you to vacate the house. It doesn't really work like that. As long as you've got a stable job and you're paying down the loan, generally speaking, it is fine because you're servicing the debt. Secondly, since you're stuck with this bank, it's going to be very hard for you to actually refinance or even get on a better rate if you decide that your rate is too high. And the simple reason being is that you have low or basically no equity in some cases, and other banks are going to be less willing to actually take you on as a customer because they're taking on the risk of having a customer with basically no equity. Now when it comes to this sort of situation with the refinance, I'm not too sure if the government guarantee actually transfers over from your current bank to the next bank. So if you are in this boat, make sure you do ask your bank or even email the government right here on this email address. You can just pause the video right here, and I've also left a link in description for this email as well. Now the other thing I want to mention is the fact that since it's going to be hard for you to refinance, the bank that you're staying with can actually increase the rate basically whenever they want and however they want, and they can actually get you to keep on paying more and more interest, which is of course going to be more costly for you guys. Now to combat this situation, what you can do is you can try to pay off the home loan as much as possible if you want and if you have the capacity to do so. And if you are looking to do that, I've done a whole separate video on that as well. There should be a link in description and there should be a link somewhere here as well. This video has 5 simple ways that you can use to actually pay down your debt very quickly. So go check this video out. I think it'll be very helpful for you guys as well. Now, guys, I am going to say that not every single bank is going to do this. And I'm not saying that this is going to happen, but this is a possibility. When I was working as a broker, I did deal with a few customers that were stuck in this situation where they had barely no equity in their property and the bank was increasing the rates as they wished. And that was pretty costly and pretty devastating for the customer. So just keep that in mind. So some other things that are being said about this scheme by some other people, not me, are the fact that because of these new incentives, they are going to obviously allow more buyers to enter into the market, and there's going to be even a more increased demand than what the demand is right now, which in turn is going to make the property prices increase even more, which again is going to hurt the borrowers and the buyers in effect. So it's basically going to hurt the people that it was designed for. Now personally, I'm not making this sort of criticism because I'm not too educated on this matter, but I thought I'd bring it up anyways because if you are looking to take on this scheme, I think that you should know the full picture and just consider everything to make sure that this is the right thing for you. Now I hope this video was helpful for you guys. Now if you do want to know more about home loans when it comes to paying it off early or looking at what affects your borrowing power, or knowing what LMI is all about, this playlist includes all of my videos on home loans, so go check it out. I think it'll be pretty helpful for you guys. And guys, thanks for watching. Please like and subscribe, and I'll see you in the next one. Bye now. Now I hope this video was